Hello and welcome to this week's edition of Econoday Unplugged. It's Tuesday, the 5th of March 2019, so that's Shrove Tuesday, Fat Tuesday or Mardi Gras, depending upon which part of the world you're listening from. Mark Pender is stateside, Brian Jackson, who probably needs a pancake as it's only 6 o'clock on a Wednesday morning in Sydney, and I'm Jeremy Hawkins here in London. So Brian, since you're with us this week, let's kick off with you. Optimism about these US-Chinese trade talks have been a key factor behind recent market moves across most markets, really. And I see China's just lowered its 2019 growth forecast. So how important is it to China to secure a trade deal? And more generally, do you think policy is currently stimulative enough to address the slowdown?
Yeah, well, I mean, we had some annual GDP numbers out probably about 4 or 5 weeks ago now that just showed that the Chinese economy grew in 2018 at the slowest pace since 1990. So this has been a sort of an ongoing trend in recent years. Economic growth is sort of settling down to more sort of long-term sustainable levels. But it's definitely an issue for Chinese policymakers because they like things to be moving a little bit quicker than what they are at the moment. And as we know, the trade situation has definitely been a factor driving that slowdown in 2018. So this growth target that they have for 2019, I think indicates that they don't want to see things slow too much further. They want to keep at least a 6 handle on GDP growth rate going forward. And to do that, they will need a bit of assistance either from the trade side or if that's not going to be strong enough, from their own policy moves that they're going to make.
Okay, another quick sort of coming at from the other angle. I saw some comments to the effect people suggesting that because we've had this sort of big rally in global equity markets of late, the rise in the Chinese market may actually restrain the scope for the likes of the PBOC or indeed the government to actually come out and loosen policy any further. Do you put any credence on that?
I think that's definitely something they'll bear in mind. And if you have a look at what Premier Li said yesterday at the National People's Congress, so this is an annual sort of confab that happens in March, where the government sort of goes to the to the sort of legislature and tells it what they're planning to do over the next 12 months. So at that conference yesterday, we had Premier Li coming in and saying we're going to keep monetary policy prudent. So not a lot of scope, I think, to move on monetary policy, but they are signalling that they're going to do more on the fiscal side. So the words he used to describe what fiscal policy is going to be doing this year is stronger, more proactive. And you see that yesterday there was some value-added tax cuts put in place, and they're expecting the budget deficit to increase as a share of GDP this year. So it looks like at the moment they're thinking more on the fiscal side rather than monetary policy.
So, Brian, this is Mark. So are they focused then on stimulating domestic demand in contrast to global or trade?
Yeah, I think that's that's a long-standing thing that they've been trying to do, reduce the dependence on external demand to support growth. That's a big issue for Chinese policymakers, and it's not something that's just going to be achieve a little tweak to fiscal policy, but that is the longer term goal, to try and boost domestic demand, and particularly on the consumer side. They've always relied on bumping up infrastructure spending whenever they want to provide stronger growth, and we can just see that model is not sustainable in the long term. They do want to try and,
So when we talk about China, then are they most global slowdown? Are they more exposed or disproportionately exposed than other economies?
Well, I mean, it depends which ones you're comparing with. There's definitely a lot of those Asian, Northeast Asian countries that are very heavily focused on trade, and China's sort of in that bracket. But I think the fact that given their size does make them hopefully a little bit less vulnerable to some of the smaller ones. But that still requires a shift in the focus and towards consumers taking out more of the slack.
Okay, thanks for that. Sticking with your part of the world then, RBA meeting on Monday, no change in rates, but is rate to be taken away from that?
The big story was probably what happened a month ago. This is sort of just confirming, I think, that shift that we saw a month ago. If you recall, straight after the February meeting, we had a speech from RBA Governor Philip Lowe, and what we've seen in recent months is that the statement accompanying each decision just gives a pretty boilerplate rundown of what is happening with the economy, and they typically just say, we think interest rates need to be where they are right now, and you get more detail in the minutes. And so over the last 6 months or so, before that meeting, we had in the minutes a description of what officials were expecting the outlook for policy rates to be, and they were expecting over that period that it was more likely that the next move in rates would be an increase rather than a decrease. That changed though last month. So straight after the meeting, we had the governor come out and give a speech, and that's where he said, we've changed our view on that, and we now think that a decrease in rates is just as likely as an increase as the next move. So that was then confirmed in the minutes for that meeting. And I think what we're seeing now is this communication strategy where the RBA is making use of some of these public appearances to get that message out rather than just a statement. And so that's going to continue actually just in a couple of hours. The governor is due to address another meeting here in Sydney, like a public event. And so we'll see if he has any further details about a shift in their views, but that seems to be the way that they're communicating at the moment.
Okay, excellent. Mr. Pender,
yes.
Now you must be particularly chuffed since you've finally got some GDP data to look at. And of course, you've got everyone's favourite employment report on Friday. So what have you got for us?
Well, it's interesting. We're talking about slowing. And if you're just looking at the headline numbers for GDP, that doesn't look like that is such a significant issue. And if you're looking at what's expected for Friday's employment report this week, that doesn't look like it slowing is that big of a threat. GDP came in at, this was last week's data, 2.6%, and it had a surprisingly good showing from consumer spending at a 2.8%. Growth rate. That's very good, especially considering how weak December retail sales are. Now, December retail sales were so weak, as I think a 1.2% headline fall, with core rates even more sharply lower. It seems to be a tag now for Federal Reserve policymakers. You're seeing it with the governors, and also you saw it last week with Jerome Powell, who specifically cited, despite all the good news, he specifically cited that those December retail sales were do raise a caution flag. And what's interesting, we don't have January retail sales yet. They'll be coming in later this month. They've been delayed. But we do have unit vehicle sales. And even though this isn't a clear-cut indicator because it includes business sales, which are stripped out for the retail motor vehicle component in retail sales, they have been visibly, significantly weak in January and February. So it looks like the motor vehicles, which is a huge part of retail sales, 1/5 of retail sales, aren't looking that good. So that's another warning flag. For whatever reason, the consumer may be coming back in, but it's probably not because of the job market. Don't forget, the January non-farm payroll growth was 304,000, far beyond expectations. Econoday's consensus for Friday's report for February is 178. Now that's about half, right? But that's still a really, really good, good number. And the unemployment rate is expected to come down 3.9, and a little bit of wage traction is in the cards here from forecasters. 0.3% monthly consensus, and a 3.4% annual rate, which would be an expansion high. It's not, an inflationary red flag yet, but it's a promising show of wage growth of forward labor market.
Yeah, would it be fair to say that in light of some of these recent Fed comments and this patient attitude they appear to be adopting now, that perhaps there's a little bit more scope for wages to accelerate without the Fed necessarily being concerned about it? Or is that not the case?
I think that is the case, and I think that it was interesting in Jerome Powell's talk to Congress last week. Was he the report specifically said that wage or that inflationary pressures were benign, subdued, at target, nothing dangerous. But he then said that wage growth is beginning to appear. But then he had to step back and say, but he didn't think that was inflationary. That's all related to productivity. Is our workers' output improvements in that exceeding what they're being paid, and presumably productivity will be going up based on last year's business investment, surge in business investment, which was another plus of the fourth quarter GDP report, and it was a huge plus in the first 2 quarters of last year, tied to the big corporate tax cut. If when that equipment gets in place, there might be a possibility for improved productivity growth, which would make these wage gains non-inflationary.
Okay. One last quick thing, just going back to talking about this global trade issue. In terms of the GDP accounts for the fourth quarter, what happened to net trade? Were there any signs of current tariffs having problems?
Yes, well, there was definitely signs in food. It's not a major, it's a surprisingly small component of actual cross-border trade, but it's showing a lot of change, and that's to the downside for the U.S. Trade is very, very typically a negative for GDP, and it was, again, a very small one. And whether that improves is completely up in the air. And the more global trade is a question, the more that's a question. But there is one positive here that I'd like to point out. We saw it in the services reports today from ISM and Market Economics. They showed a little bit of an improvement, and in the ISM, more of an improvement in service exports. U.S. service exports are very, very strong. They don't get a lot of headlines because they're a smaller percentage than goods, but it's a growing. It's an exceptional over the last 15 years. Growth has been exceptional, and if that continues, and it seems like in these trade talks, services are a distant aside. Talks seem to be centered on goods. So even if there is trouble in goods, maybe U.S. services can help offset some of that trouble.
Okay, interesting. Thanks for that. Okay, well, I guess in my part of the world then, main focus this week probably won't be Brexit, although you've always got to keep an eye on that because we have ongoing discussions as we speak. But on Thursday, we'll have the next ECB meeting of 2019. What to expect from that? Well, in terms of the major policy parameters, nothing really. We won't see any change in interest rates. So the refi rate is still down at 0%. And we almost certainly, I suspect, won't see any change probably in the forward guidance as well. And that's going to be, I suppose, if anything, the key thing to concentrate upon, because as things currently stand in terms of interest rates, of course, the bank is still plugging the line that current levels are going to be around at least through to the end of summer this year. And I think because of the weakness we've had in the Eurozone economy, growth last quarter was just 0.2% on the quarter. The first quarter looks to have started off pretty softly as well, and core inflation is still stuck at 1%. Rather growing concerns that the ECB is going to undershoot its forecasts. So I think probably one of the main focal points of this meeting will be what the ECB itself does with its own forecasts. Now, the ECB's already revised down its forecast 3 times since the middle of last year, and there's every chance that its growth numbers will be hacked again once we get into Thursday. If we were to see that, it doesn't necessarily have any immediate implications, but clearly it's going to have markets speculating that much more about the probability that key interest rates won't be hiked at all in 2019, and indeed perhaps they'll continue to hold around current levels well into 2020. So do keep an eye on what they're saying with their forecast numbers. With regards to forward guidance, there was some pressure at the back end of last year for the ECB to actually come out with an out-and-out cut-off definitive date for its holding interest rates stable, but that looks very unlikely, and indeed it may be the case will actually push out this soft close into summer even further out throughout the rest of the year. Indeed, they could actually just simply come out and say, well, interest rates will be data dependent and leave it at that. But either way, it's difficult, I think, to see much coming out of the ECB meeting Thursday, which will be helpful as far as the euro is concerned. One last quick comment on that I should mention is that if we do see any change in policy, it could come via the reintroduction of what they call these TLTROs, which are targeted longer term refinancing operations. That wouldn't really have anything to do with quantitative easing, but it would be a sign that the banks are becoming aware that some banks, particularly central banks, becoming aware that some banks, particularly in Italy, could have some funding problems as we go through this year. So that's another thing perhaps just to keep an eye on. Also, just quickly sticking with central banks, we'll have the Bank of Canada meeting on Wednesday. Amongst all the banks we've been talking about just today, they're one of the very few who still seem to think that interest rates will be going up and it's just a matter of time before they do so. So they still have a tightening bias at the moment. It's very unlikely we'll see any change in interest rates come Wednesday. So their key target for the overnight rate remaining at 1.75%. But we could possibly see a shift in the tightening bias. Last week, we saw some extremely soft fourth quarter GDP data out of Canada. They've had declines in GDP in November and December. So it's possible we could see a shift to a neutral, which perhaps could hit the currency a little bit. But by and large, it looks as if the time being, they're still taking a view that the slowdown in the Canadian economy is just going to be temporary. If that's the case, then probably this tightening bias is going to hold. Okay, I guess probably my little lot. Anyone else for anything else?
I do. I have a question. This is Mark. Brian?
Yep, I'm still here.
I have a question about New Zealand. Now, they had a meeting a week or two back, and after the RBA, I was looking at it thinking, well, maybe they'll shift down a little bit too. How should we look at New Zealand as a possible pre-indicator?
Yeah, I haven't really heard too much talk about an imminent shift in their policy outlook. They've been, I think they've sort of always been where the RBA has just moved to. Like they've been consistently saying that they're not ruling out a decrease or an increase going forward. So they've had a more balanced view for a while now, and I think it's more the case that the RBA has followed their lead and has sort of moved into that position.
Okay, everyone at peace? So that's probably it for today then. On behalf of Mark, Brian and myself, thank you as always for listening. I'm off for a pancake, and we'll be back again next week. Bye for now.